We're back again on another Monday, and today we're going over my TFSA portfolio week 3 update. In this video, I'll be going over the Biden infrastructure plan and stocks that could benefit from this. Next, we'll go over my portfolio in the spreadsheet. Then I'll talk about 2 stocks that I'm planning to buy this coming week. And lastly, we'll be answering a question from last week's video. We'll be trying to keep this video short and sweet in under 10 minutes. And if you guys get 500 likes on this video, I'll be releasing my free portfolio spreadsheet tracker. So remember to leave a like down below. So starting off, let me talk a little bit about my thoughts on the whole Biden infrastructure plan and what sectors might benefit from this. So the gist of the Biden infrastructure plan is that he plans to spend $2 trillion over the next 10 years or so to build up infrastructure in America. These could be things like bridges, roads, electric charging stations, and all these infrastructure plans are going to require a lot of materials. So materials like concrete, lumber, as well as electrical equipment. The obvious sectors that will benefit from this are your materials and resource sectors, as well as infrastructure sectors. You can also look for companies that are down the stream that are involved with providing tools towards these companies. One of these companies could be Caterpillar, which provides the large machines that are required for building any sort of infrastructure. Now, before you go out and rush and buy these companies, well, just know that the market has already probably taken this into account. But one thing that you should know about this infrastructure spending is the fact that corporations in America are going to be paying for this. And as a corporation, you really don't want to pay for it because that's increasing your own tax bill. So there's going to be a lot of fight back, and likely the spending will be reduced as they find some sort of happy medium. So in my opinion, I think that right now may not be the time to invest in these companies as they've probably run up after the plan was announced. Consider waiting a little bit later until there's a bit more confirmation, as there's going to be a lot of back and forth between the corporations and the government. So we're here on my public TFSA tracker, and first we're going to go into the transactions tab. So this week I didn't buy any new stocks, however I've just been adding to positions that I currently have. I did all my buying on April 1st or April Fools. Don't worry, these are not a joke. So the first stock that I bought was Sun Life, and I bought a single share at $63.58. Then I bought another share of HXQ, which is the Horizons NASDAQ 100 ETF. And I bought one share because it's relatively expensive for my $200 deposits every single week. I bought one share at $94.17. Next, I added another share of TELUS Corp just because it came down after they released their latest round of financing. So I bought one share at $25.32. And lastly, I added to my GDMP position, added 30 shares for $1.17. Just earlier, I made a deposit of $200, so I'll log that in right now. So now that we logged that in, we can see cash has increased by $200. Now looking at the total portfolio, we can see currently we have $200 of cash, which I'll be spending next week. And if we look at the 1 week performance of this portfolio, let's see which stocks did well and which ones didn't do so well. So over the past couple of weeks, we can see that these 4 stocks right here, Enchos, Well Health Technologies, Kinaxis, and GDMP. These are the more high-risk plays, and we can see that they went up respectively of 2.43%, 3.2%, 6.4%, and 9.65% for GDMP. So it looks like overall the market decided to buy back into the more high growth names, and they sold off the names that are a bit more safer and dividend play companies. So the companies that didn't do so well this past week was RioCan, Power Corp of Canada, Algonquin Power and Utilities, as well as TD Bank, which was actually pretty much flat on the week. But overall, if we look at the general trend of the portfolio is up for the most part. Now, if we look at the portfolio metrics here, we can see the TSX change since March 16th has been positive 0.09%. However, my portfolio change has actually gone down by 0.24%. This is still relatively short term as March 16th was only half a month ago. Currently, the total dividend yield of my portfolio is 1.66%, and the total yearly estimated dividends is 43.71%. Later on, I'll probably build in a tracker to show how much my dividends have increased every single month as I add more dividend stocks. The total value of my portfolio today is $2,633.48, which is down just slightly from the book value of $2,639.94. With the addition of new stocks this week, as well as the influx of cash, Currently, the portfolio risk is weighted more towards low-risk investments. Medium risk still makes up around 1/3, and the high-risk portion has dropped significantly from 27% to around 23.6%. Now let's jump back over to the studio and talk about the 2 stocks that I'm looking to buy this upcoming week. The first stock that I plan to buy next week is Enbridge. And before you guys click off, let me tell you why I'm buying Enbridge. The first reason is their dividend is pretty juicy at over 7%. If you look at their payout ratio, it's over 100%. However, if we look at the cash from operating activities, this is easily able to support the dividend. And the reason why the cash flow from operations is so much higher than their net income is because of the depreciation expense that they have. The pipelines and all the equipment that they have depreciates at a fairly significant rate every single quarter. And a depreciation expense is not an actual cash expense, it's just the business able to write off some of the equipment that they purchased. But the equipment can continue to be used after it's fully depreciated. So in looking at the safety of Enbridge's dividend, I prefer to look at the free cash flow from operations versus the dividend payout. The second reason I'm buying Enbridge is because currently I don't have any exposure to oil and gas, and I believe that Enbridge is probably the safest play than rather buying into a pure oil and gas company. The third reason why I'm buying into Enbridge is because I ran a quick DCF calculation, and I've linked that down below if you want to check that out. And currently they're trading at roughly fair value versus the rest of the market right now. There aren't many stocks that are trading undervalued or even at fair value. So for these 3 reasons, I'm looking to buy into Enbridge next week. The second company that I'm looking to buy is Stella-Jones. And Stella-Jones is a manufacturer of pressure-treated wood. Pressure-treated wood is used in a variety of applications, such as for decks, for fences, for railroads, as well as just general infrastructure. And as I mentioned before, with the whole Biden infrastructure plan, Stella-Jones could be a recipient of some of that business. And even if they're not a direct recipient, the fact that there's going to be a lot more demand for manufactured wood, this is going to increase the prices all around for the entire industry. The PE ratio of this company right now is 16.5. As well as they've been growing their revenues for the past couple of years, and the dividend payments have been increasing every single year since 2012. Stella-Jones is another way for me to diversify my portfolio because currently I don't have any holdings in basic materials. And really the main driving point for investing here is the fact that I believe lumber will be in high demand over the next couple of years. So last week we had a question from Keith B, and his question reads, can you tell me what the difference is between Wealthsimple Trade TFSA and the Wealthsimple Invest TFSA? Cheers. So Keith, the difference between Wealthsimple Trade and Wealthsimple Invest is the fact that Wealthsimple Trade allows you to buy individual stocks. On Wealthsimple Invest, you're essentially investing into these funds that Wealthsimple Invest creates. In these funds, they have different portions of stocks and bonds in them. And for the most part, these funds are managed by algorithms. So with Wealthsimple Trade, it's a more active investing method where you have to actually go in and put the work and choose which stocks to buy. Versus Wealthsimple Invest, they just give you a basket of stocks within a fund and they ask for your risk level and you invest your money based on that. So if you want to take the route of laid back investing, then Wealthsimple Invest is a platform that you want to go for. But if you want to learn about investing and try it firsthand by investing in your own individual basket of stocks, then Wealthsimple Trade is a platform for you. That's all I have for today, and remember to leave a like down below because if we hit 500 likes, I'll be releasing a free copy of a spreadsheet for tracking your portfolio. And here's another challenge. If we hit 2,000 likes, I'll release a beta version of my actual portfolio tracker spreadsheet that you've seen in this video. If you want to check out the previous weeks of this challenge, click these videos right up here. If you're there, I'll see you there. If not, keep up the grind and have a great day.